There's a story everyone in tech seems to know. Yahoo turned down buying Google for $1 million back in 1998. It gets repeated in talks, in tweets, in biggest business mistakes ever listicles. It's also not quite right. And the real version is more interesting than the myth, because it turns out two different companies made the same mistake, years apart, at wildly different price tags. Let's start with what actually happened. In 1999, Google's founders were still running the company out of a garage. They weren't trying to build an empire yet. They offered to sell the whole thing to a search engine called Excite for somewhere around $750,000 to $1 million. Excite's CEO, under pressure from an investor who thought even that price was too high, turned it down. That is the real $1 million near miss. It involves Excite, not Yahoo, and almost nobody remembers Excite's name today, which is itself part of the story. So where does Yahoo actually come in? A few years later, in 2002, once Google was clearly succeeding as a search company, Yahoo's own executives seriously explored buying it. By then, the price wasn't a rounding error anymore. It was billions. Reports describe Yahoo offering around $3 billion, while Google's side wanted closer to $5 billion. The gap never closed, and the deal fell apart. Over time, both stories got flattened into one internet legend. Excite's founders quietly disappear from the retelling, and Yahoo gets stuck playing the villain of an anecdote it wasn't even part of at that price point. Here's the part that actually matters for anyone who manages people or makes, buy, build, or hire decisions. Both stories show the same underlying lesson, just at different scales. Excite's leadership looked at an unproven search company and saw an expensive luxury, not a future giant. Yahoo, years later, still treated a fast-growing search business as a big but ordinary acquisition target instead of the era-defining company it was about to become. By the 2010s, Google had grown into one of the most valuable companies in the world, while Yahoo's relevance and value steadily declined, eventually selling its core business to Verizon in 2017 for a fraction of its earlier peak valuation. Now here's the part nobody expects when they first hear this story. The mistake wasn't really about money at all. It was about which mental model each company used to size up the opportunity in front of them. This is where it gets useful for managers, because the same mental shortcuts that tripped up Excite and Yahoo show up constantly in ordinary workplace decisions, just with smaller numbers and lower stakes. Psychologists call one piece of this anchoring bias a concept that decades of behavioral research, going back to the classic work of psychologists Daniel Kahneman and Amos Tversky, has shown affects almost every kind of numeric judgment people make, from price negotiations to courtroom sentencing estimates. When you're handed a number, whether it's an asking price, a budget line, or a first-year salary offer, that number becomes the reference point for everything that follows, even when it has nothing to do with the thing's actual future worth. Excite's investor reportedly pushed to negotiate the price down even further, treating Google as a discount item to be haggled over, rather than an asset whose value might be growing faster than the negotiation itself. Once you anchor on, "This is worth less than $1 million," it becomes very hard to mentally reprice something as, "This could be worth billions in 3 years." The number in front of you crowds out the trend line, and the more precisely that first number is stated, the harder it is to move away from it later. A second piece is present bias, sometimes described as hyperbolic discounting. Human brains are wired to weigh a certain immediate cost or gain much more heavily than an uncertain future one, even when the math says the future outcome is larger. $1 million in hand, or saved, feels concrete. $5 billion of hypothetical future value feels abstract, uncertain, maybe even a little unreal. Yahoo's executives in 2002 were not unintelligent. They were reasoning the way most people reason, discounting an uncertain future heavily against a very certain present. A third piece, and probably the most relevant one for day-to-day management, is status quo bias, combined with a failure of imagination about growth curves. Both Excite and Yahoo were evaluating Google using the assumptions of their own current business models. Excite thought of itself as a portal competing with other portals on traffic and ad placement. It evaluated Google through that lens as another search feature, not as a company that might redefine how information itself gets organized. Yahoo, even years later, was still thinking like a media and advertising company sizing up a search division, not recognizing that search was about to become the dominant gateway to the entire internet. Neither company was stupid. Both were using yesterday's mental map to price tomorrow's territory. It's worth separating this from a related but distinct effect: loss aversion, which is the tendency to feel the pain of a potential loss more sharply than the pleasure of an equivalent gain. Loss aversion explains why Excite's investor fought so hard over the last few $100,000 of a negotiation that marginal loss felt vivid and immediate, while the far larger, purely hypothetical future loss of walking away from Google felt fuzzy and easy to discount. Anchoring bias, present bias, and loss aversion are three separate mental shortcuts, but they tend to gang up together in exactly these moments, each one nudging the decision-maker further toward the safe, familiar, present tense answer. It helps to see this pattern outside of Google's story too, because it is not a one-time fluke, it's a recurring shape in business history. Consider the widely told story of Blockbuster and the small mail-order DVD company that eventually became Netflix. Blockbuster's leadership, according to popular accounts, looked at the early streaming and mail-order rental model as a niche curiosity, not a threat to their retail business, and chose not to pursue buying it. A few years later, streaming reshaped the entire industry, and Blockbuster's storefronts became irrelevant almost overnight. Or consider Kodak, a company that famously built early digital camera technology inside its own labs, long before digital photography went mainstream, yet stayed slow to shift its core business away from film because film was still the profitable, proven bet sitting right in front of it. In every one of these stories, the company evaluating the new thing wasn't blind to it. They saw it clearly. They measured it against the wrong yardstick, the one built for their existing business, instead of asking what yardstick the future would actually use. What makes these stories land, again and again, is that the people involved were experienced, well-resourced, and not careless. They had committees, analysts, and financial models. The model simply asked the wrong question, because the wrong question is the comfortable one, the one anchored to numbers everybody in the room already trusts. Now imagine a smaller, much more ordinary version of this same dynamic, one that plays out inside almost any company, every quarter. Imagine a team lead evaluating whether to invest in a new internal tool that automates a slow, manual process. The tool costs money now, produces mediocre results in its clumsy first version, and doesn't fit neatly into this quarter's budget. It gets shelved as not worth it yet. 2 years later, a competitor has automated the same process, doubled their output per employee, and the manager is scrambling to catch up from behind. Nothing about the technology was hidden. It was priced using the present, not the trajectory. Or imagine a hiring manager interviewing two candidates. One has a flashy resume and immediate, provable skills that map neatly onto this year's job description. The other is clearly less polished right now, asks unusually sharp questions, and shows a pattern of rapid skill growth over a short career so far, but doesn't check every box today. Managers under time pressure very often hire for the present tense checklist, because it is easier to justify and lower risk in the moment, even when the growth trajectory candidate would have been the far better long-term bet. This is the Excite mistake, replayed at the scale of a single hiring decision instead of a billion-dollar acquisition. Or imagine a product manager reviewing a small feature request that keeps showing up in customer feedback, but only from a thin slice of current users. Judged purely on today's usage numbers, it looks like a low priority, a nice-to-have buried at the bottom of the backlog. What that snapshot misses is why that thin slice of users wants it and whether it points at a shift in how the whole market is about to behave. Features that look marginal in year 1 sometimes become the entire product in year 3, and the only way to catch that early is to ask the trajectory question deliberately, instead of letting this quarter's usage chart make the call by default. Or picture a manager evaluating a small, scrappy competitor doing something slightly different at a fraction of the customer base. It is tempting to dismiss a competitor like that because their current revenue, current headcount, and current market share all look unimpressive next to your own. But current size tells you almost nothing about trajectory. Growth curves are exponential before they are obvious, and by the time a competitor's size finally forces you to take them seriously, they have often already built habits, technology, and brand loyalty that are extremely expensive to catch up to. This is exactly the shape of Yahoo looking at Google in 2002 and still seeing a search company rather than the company about to own the internet's front door. There is also a related opposite failure worth naming, because managers can overcorrect in the other direction. Not every early-stage tool, hire, or competitor is secretly the next Google. Most aren't. The skill being described here isn't always assume exponential upside, which leads to its own kind of wasted investment chasing every shiny new thing. The actual skill is building a habit of explicitly asking the trajectory question before making the decision, rather than defaulting to whatever the current price tag or current resume happens to say. Sometimes the honest answer to what could this become in 5 years really is probably not much, and that is a useful, disciplined answer too, as long as you actually ask the question instead of skipping it. There's also a version of this that shows up in promotion decisions, which many managers never connect back to acquisition mistakes at all, even though the underlying error is identical. An employee who is steady, reliable, and fully competent at their current level often gets promoted ahead of a less experienced employee who is visibly improving faster than anyone else on the team. The steady performer is the safer, easier, better documented choice today. The fast-improving employee is a bet on a trend line, and trend lines are harder to put in a promotion memo than a track record. Some of the best long-term hires and promotions in any organization look in the moment, like the riskier choice, precisely because their value is still mostly in the future rather than already banked in the past. Part of why trend lines are so easy to underprice is that exponential growth does not look dramatic in its early stages. A curve that will eventually shoot upward looks almost flat for a long stretch before it bends sharply. Anyone glancing at it early sees something that looks slow, unimpressive, easy to deprioritize. That is precisely the window in which Excite saw Google, and in which Yahoo, a few years later, still underestimated it. The curve wasn't hidden. It just hadn't visibly bent yet. And human intuition is notoriously bad at extrapolating a bend that hasn't happened yet from a line that currently looks flat. So what does this look like in practice, concretely, for someone managing a team or a budget right now? A few habits map directly onto what went wrong for Excite and Yahoo. First, before rejecting a proposal, a hire, or a small competitor purely on today's numbers, explicitly write down a one-line forecast what this looks like if current growth continues for 3 to 5 years, not just this quarter. Writing it down matters, because vague gut feelings about probably fine are exactly the mental shortcut that let 2 different companies underprice Google. Second, separate the "is this priced fairly today" question from the "what is the trend line" question, and answer them one at a time instead of blending them into a single gut reaction. Excite's investor was optimizing the first question, negotiating the price down, while completely ignoring the second question, whether the price mattered at all, next to the trajectory. Third, build a specific moment into recurring planning cycles, quarterly or annually, to revisit anything your team dismissed as not worth it yet, and ask whether the underlying trend has changed since the last time you looked. Most missed opportunities aren't missed in a single decision. They're missed by never being revisited after the first no. Fourth, assign someone in the room the explicit job of arguing the trajectory case, even when everyone else is focused on today's price or today's resume. Excite and Yahoo both had rooms full of smart people, but nobody in either room had the job of saying, "Ignore the number for a second. Where is this actually headed?" Giving one person that job on purpose, even informally, costs nothing and catches exactly the blind spot that sank both deals. One more thing worth saying plainly, in my own view, having looked at both of these deals side by side. The most uncomfortable part of this story isn't that Excite or Yahoo made a bad call once. It's that the exact same blind spot survived, completely intact, inside a different organization, at a completely different price scale, only a few years apart. That is not a story about 2 unlucky companies. That is a story about how naturally this particular mistake reproduces itself because it isn't really a failure of information, it's a failure of which lens you choose to look through. Google wasn't hidden from either company. It was priced by people using the wrong ruler. For managers evaluating an acquisition, a new technology, a hire, or a competitor right now, the lesson from both of these stories holds either way, whether the number in question is $1,000 or $5 billion. The price you're offered today rarely reflects what something is about to become, and by the time that gap is obvious to everyone, it's usually too late to close it cheaply. The teams that actually get ahead of this pattern aren't smarter in the moment. They've just built the habit of asking the trajectory question on purpose, instead of waiting for the trend to become undeniable. None of this requires predicting the future with any real precision, which is good, because nobody can actually do that reliably. It just requires refusing to let today's number be the only question that gets asked in the room. Excite asked what Google was worth that week. Yahoo, years later, asked roughly the same narrow question at a bigger scale. Neither team asked what the search business would look like in a decade, out loud, on the record, as a formal part of the decision. That single missing question, asked consistently and on purpose, is a cheap habit for any manager to build, and it is the entire difference between these two stories and a very different outcome. Follow for the psychology behind how teams actually work.